When an approved customer invoice recording an inventory sale or return is saved in Carillon, Carillon records both the actual revenue and the actual cost of goods sold on the invoice line. Gross profit is not a separate disconnected value that must be manually stored or synced. It is calculated directly by subtracting the actual cost from the actual revenue on that same invoice line record. The cost is not an estimate. It reflects the inventory costing method in use for that item, whether FIFO, average cost, or standard cost. Once the invoice is posted, ordinary application users cannot silently rewrite the posted revenue or cost amounts in a way that bypasses the audit trail. Corrections are handled through proper accounting procedures rather than by altering the original historical record. This design makes profitability reporting direct. Whether a controller wants gross profit by item, customer, salesperson, branch, project, or ship to address, the calculation comes from a single source: the invoice line record, revenue minus COGS, no estimation, no fulfillment to invoice correlation step. For real-time Power BI reporting, the dashboard can query the same invoice line data that holds both the posted revenue and the posted cost together. NetSuite works differently. Oracle's own documentation categorizes its native gross profit feature on sales transactions as an estimated feature. Oracle says the gross profit feature estimates gross profit using estimated item costs and proposed discounts. Oracle's FAQ is even more direct. When asked whether the gross profit feature provides actual costs and margins or only estimated ones, Oracle answers only the estimated costs and margin. The architecture behind that distinction can also create timing and matching considerations. Oracle documents that fulfillment posts the inventory reduction and COGS impact, while billing the customer is handled through a cash sale, invoice, or other billing transaction. Oracle also documents that when advanced shipping is enabled, fulfillment and invoicing are independent processes, and shipments can be recorded separately from billing. That separation matters when dates cross accounting periods. A NetSuite consulting firm has written that, for product-centric companies using sales orders, COGS is generally recognized when the item fulfillment is marked shipped, while revenue is generally recognized when the transaction is invoiced. The same firm advises customers to match invoice dates and accounting periods to the related item's fulfillment dates and accounting periods, warning that accounting period mismatches must be avoided. NetSuite does provide profitability reporting. Oracle documents a customer profitability detail report that shows cost, revenue, and profit amounts categorized by customer. The issue is not that NetSuite cannot report profitability. The issue is where the native invoice gross profit numbers originate. Oracle's documented invoice gross profit fields are estimated fields. Carillon's invoice line stores actual revenue and actual COGS together, so actual gross profit is calculated directly from the same posted invoice line record. Both systems can produce profitability reports. The difference is how direct the actual invoice level calculation is. With Carillon, actual revenue and actual COGS are already together on the invoice line. With NetSuite, Oracle's own documentation describes native invoice gross profit as estimated, while actual COGS is generated through fulfillment and inventory costing. For controllers who want real-time actual gross profit by item, customer, branch, project, salesperson, or ship to address, that is a meaningful architectural difference.